Greetings to everyone. Hope we are back again here, and today I will be starting a recording on corporate reporting. Right, it's been a tough semester, and we are almost through exams. And the little I know about corporate reporting is what I'm coming to see because this is actually my first course in the speech. Yeah. So we'll quickly go through consolidated financial statements, right? So that's what we are going to talk about today. And we are going to start with financial position. So after that, we will solve one question before we leave, and then. But today I'll be focusing basically on the parent and then a subsidiary relationship. Next video, I'll bring in an associate, and then next video I'll try and then bring in the income statement, the contributed statement of income statement. And then yes, sir. All right, so let's just ignore the English. And basically, this is what I'm going to do with today, right? And after that, we will solve this question and then we will move on. All right, so now this is an introduction, which I'll be tackling some part of this slide and then I will skip something. So, today is a topic, an introduction to accounting for goods, corporate goods. So, um, corporate growth in the last century has been fundamental, internal, which is by investments in projects, and external by purchasing another company, with or without a consent from existing directors. So we also deal with business combination, which often a dominant company that takes control of another entity, although there may be a softer merging of several entities. So in class, our lecture cited an example that group Indum is not a group, right? It's not considered as a group under the IFRS standards. So at the end of this session, you understand what a group is, or who, or what can we say that is a like we have in what situation will we say we have a parent subsidiary relationship, right? So these are all kind of like they are just one person forming together as a GN. It's a family business group, Ghana and American origin. It doesn't make it a group under the IFRS. So now formation of a group. But what is a group? So a group is where there is one or more companies being controlled by one parent, right? So what this basically is trying to talk about is that, let's say there is a parent company there, there's one company there that has interest in other companies, right? Or buying the shares or buying some controls in other companies. So when the parent company buys more than 50% control or 50% share of the other companies, we say that there is what? There is control, right? So taking Indum Group as an example, where it's only one person who has created those businesses. So it is not a group. The group occurs when there is a parent who is buying more than 50% shares in another group, right? So um that's why I say usually have greater than 50% equity. And then there's an exception to this. Sometimes um, the parents might have less than 50%, but they will agree that I will control the group. You understand? Yes. So that is one that controls is a parent or a holding company, and the subsidiary company is the one being controlled. A parent control over a subsidiary is exercise true dominant influence power over the financial and operating policy of the subsidiary. So in a parent-subsidiary relationship, a group exists and therefore consolidated group accounts are prepared. So whenever there is a parent subsidiary relationship, we consolidate their financial statement. What this means is that we combine them. So when you take the PPE of the parent, when you take the PPE of the subsidiary, add them. When you take the parent asset, let's say inventory of the subsidiary and inventory of the parent, you add them. So you are going to add everything line by line in the statement of financial position, except something like equity. We won't do that, right? So as we move on, we are going to understand what we are supposed to do for preparation for our exams. And also, what do I even want to say? What I wanted to say is that whatever we will need to adjust the financial position will be dealt with in this video. So the 5 basic workings will be dealt with in this video. So the parents may not own all equity. So there are some situations where the parents can own like 60%, 70% to 80% of the equity of the subsidiary. So the 20% or the 40% that is left will become the non-controlling interest. So non-controlling interest is a situation where the equity in a subsidiary, that is like the equity that is in a subsidiary is not attributable to the parent. So that part of the equity that is not attributable to the parent is the non-controlling interest. So we also will later on, maybe tomorrow, talk about associates. So the associate is more or less like an investment in another company, but you have less than 50% control, right? Okay. So with that one, we don't consolidate the account. We just look for profit that we've made there, and then we add it to our normal profit. So an entity in which an investor has significant influence and which is neither a subsidiary nor a joint venture of the investor. Significant influence is the power to participate in the financial and operating policy decisions of an economic activity, but not control over those policies. Here, the influence is not dominant, it is significant, right? Joint venture, it is a contractual arrangement where 2 or more parties undertake an economic activity which is subject to joint control. So these are just some histories about reporting of such group, right? So we didn't really talk about history like that. So purpose of consolidation. A parent must normally prepare consolidated accounts to prevent inflation of sales, to provide a meaningful earnings per share value, and also to be a better measure of performance. So these are some standards that deals with, these are some of the standards that deals with what we are coming to treat today. So these are the standards that governing consolidated financial statement, whatever you are. So we have the IAS 27, which talks about consolidated and separate financial statement. So under IAS 27, a group exists if one enterprise, which is a parent, directly or indirectly controls another. That is, there is a parent-subsidiary relationship. Then there is a need to consider the impact of potential voting rights that are currently exercisable or convertible. So controls may be lost if parent sells shares or the subsidiary becomes subject to control by a government, court administrator, or regulator. In this event, the subsidiary must be derecognized. So we move on to IFRS. It talks about business combinations. So it's defined business combinations as the power to govern the financial and operating policies of an entity, subsidiary, so as to obtain benefits from its subsidiaries' activities. So the entity with the power is the parent, right? And the other one is a subsidiary. So control or influence. We see control versus influence. So there is control. when parents have greater than 50% voting rights of the subsidiary, right? So control also exists if parents acquires power over 50% by way of agreement. Mm. So to govern financial and operating policies, to appoint or remove majority of board, to cast majority of votes at board influence. And associate companies and significant influence will be dealt with later in this sessions. All right, so IFRS 10, which is the consolidated financial statement, requires a parent entity to present consolidated financial statement. It defines the principle of control and establishes control as the basis for consolidation. It sets out how to apply principles of control to identify whether an investor controls an investee and therefore must consolidate the investee. It sets out the accounting requirement for the preparation of consolidated financial statement. It defines an investment entity and sets out an exception to consolidating particular subsidiaries of an investment in. The reason I'm just trying to do this readings is that sometimes exams will come and then it wouldn't be you solving. It might be you understanding some of the terms in the consolidated financial statement. That's why I would have skipped straight to the calculations. So this is how a structure can be. Parent, subsidiary one, subsidiary two, and then associate. Sometimes it can be parent, subsidiary one, associate. Sometimes to parent, only associate. Sometimes to parent, subsidiary one, subsidiary two, subsidiary three, subsidiary four, up to the distance. So we also have complex group structure. So complex group structure happens when a parent have shares in subsidiary, and a subsidiary also have a share in another company where that parent is also having a share in that company. So for example, let's say parent here, subsidiary, parent is having share in subsidiary one and also in subsidiary two. Then subsidiary two, a subsidiary one is also having a share in subsidiary two. Even though parent is also having a share in subsidiary two, right? The subsidiary one is also having share in subsidiary two. It makes the group what complex. So you have to calculate and do some adjustment and stuff. That's why they call it complex group structure. So we'll talk about this, but complex group structure, don't know whether it will be treated at our level, but we'll see. So sometimes they call it D-shape. This is an example. So this is an example where ultimate parent D, then subsidiary one is having shares in subsidiary A and B, subsidiary two, associate C, and then this one is also having this, right? And a situation where parent is having shares in all these subsidiaries. That's what it's trying to do. So, for example, here, this is a vertical one where a parent owns shares in subsidiary S, and also S also have influence in subsidiary C, right? So with this, it doesn't really do this, but so look at it here. Uh, S S Limited is having 75%, right? So NCI is what? 25%. So basically, in defining the group structures, you know, once you find that the parent is having 75, then the subsidiary is having what? 25, because everything is over 100, right? And if the parent is having some, then the subsidiary is also having some. So we might look at some situations there, which are all some complex groups. So the content of a group account. So the parent financial statement. So if you want to create a group account, you take the parent financial statement and then the subsidiaries financial statement. Then you examine and then merge them, right? So that is it. So which includes the statement of financial position, the income statement, the statement of cash flow, and also the notes. So IFRS 10 Appendix A defines consolidated financial statement as the financial statement of a group in which the assets and liabilities, equities, income, expenses, and cash flows of the parent and its subsidiaries are presented as those of a single economic entity. You get it? So you take all of them, I've explained this earlier in this chapter, you take all of them, then what? You add them as if they are what? Single entity. So some exclusions, right? So a situation where a parent may dispose the subsidiary is there. So with that one, we also do so when a parent issues consolidated financial statement, it should consolidate all subsidiary, both foreign and domestic. A parent need not present consolidated financial statement only if and only if all the following are held. A parent which is itself a subsidiary not prepared. So if you're a subsidiary, you don't prepare the accounts of the group. If it's a wholly owned subsidiary, 100%, and the ultimate parent produces IFRS account, then you don't need to present. If it's a partially owned subsidiary, the other owner must what agree. Then its securities are not publicly traded, then you don't need to consolidate. It is not in the process of issuing securities in public security markets, then you don't need to consolidate. The ultimate or intermediate parent publishes consolidated financial statements that comply with the international financial reporting standards. The rules on exclusion of subsidiary from consolidations are necessarily strict. Control must actually be what? Lost for exclusion to occur. So exemptions for now remove temporarily holding for resale. If you are holding a particular company for resale, right, then you don't need to what consolidate it initially. Then initially it was what the similar activity. So if the companies are not doing similar activities, then no need to consolidate. Then severe long-term restrictions. I just want to skip some parts. Just want to talk about what is. So IFRS 10 requires that, so date of inclusion and exclusion. IFRS 10 requires that the result of subsidiary undertaking to be included in the consolidated financial statement from the date of acquisition, that is the date on which the investor obtains control of the investee, to B, the date of disposal, that is the date the investor loses control of the investee. Then once an investment is no longer a subsidiary, it should be treated as an associate. So where let's say the parent loses control of more than 50%, then it should be treated as an associate under IAS 28 and as investments under IFRS 9 if possible. So methods of accounting. So in accounting for subsidiary, we have the purchase technique, where it is more or less like you purchasing it, and then the pool of interest, which is not worldly accepted like that. We also have the equity method for associates, and then we have equity method for joint ventures. So the governing standard is still IFRS 27, IAS 27, IFRS 10, IAS 28 and 31, IFRS 11. So let's look at this. So IAS 27, talking under these methods, was that it outlines the accounting and disclosure requirement for separate financial statements which are financial statements prepared by a parent or an investor in a joint venture or associate, where those investments are accounted for either at cost or in accordance with IAS 39 financial instrument, recognition and measurement, or IFRS 9, which is financial instrument. IFRS 9 was investment. The standard also outlines the accounting requirement for dividend and contains numerous and disclosure requirements. So what's our main focus? Our focus in this session is subsidiaries using Fitch's technique. So pooling interest heavily restricted internationally and the like. Associate joint ventures and equity methods later in the. So now, so the Fitch's technique. So under the IFRS 3 and IFRS 10, they view the group as an economic entity. They view the group as an economic entity and treat all equity providers, including the non-controlling interest, as shareholders in the group, and therefore requires the need to recognize the goodwill attributable to non-controlling interest. So the revision of the IFRS has introduced a choice of valuing goodwill at acquisition, either using the proportion of net assets method and also the fair value method. We will treat this very soon. So, which is also referred to as full goodwill. So initially, they used to treat acquisition-related costs. Let's say when you were trying to buy the company or trying to own shares in the company, the agency and those kind of fees that you would have paid. Initially, it was being treated as a cost of acquisition or the cost of acquiring. So it would be what? Included in your total cost. But now it has been revised to treat it as what? As an expense. Then contingent consideration. It's more or less like you saying that you pay only when, let's say, something happens. So let's say you buy some item from someone and be like, maybe I use the item for this particular days. I'm not going to add the rest of the money, right? So it is more or less like a deferred consideration. So purchase consideration, price paid by the parent to acquire interest. So we can use shares, we can apply cash, we can buy with cash. So buying with cash means that our cash will reduce, right? And then our investment will increase. But exchanging with shares, meaning that our shares is going to increase, right? So we will look at this very soon. Any deferred consideration should be discounted back. So if you are planning to pay an amount of money in the future in addition to the purchase, then you have to discount it back using the time value of money formula that we normally do. We did in business finance, right? And any contingent consideration should also be discounted back. So when do we say goodwill is, we'll talk about this very soon, but when do we say goodwill has come to stay or is now being valued? So when, let's say, you buy an asset, you buy a company for 50,000, where the actual value of the firm is 40,000, then the difference becomes goodwill. So the goodwill rises in a situation where the amount you paid for the firm is greater than the actual value of the firm. So we'll talk about this very soon. Negative goodwill is as a situation where maybe you were able to bargain and you purchase the company lesser than its actual value. So here is the case. Let's say the company is worth 50,000 and then you bought it for 40,000, right? So we'll talk about this very soon. Then minority controlling interest, where we have spoken about is that if the, the company, if the parent buys, let's say 80%, the 20% becomes of non-controlling interest, the same as minority controlling. So regardless of whatsoever, we add assets and liabilities together in the statement of financial position when we are consolidating, but we don't add equity. All right, so now let's move on to some basic workings that we need. So construction of basic consolidated financial statement. So now, under this session, we are going to look at the basic basic workings, right? So our focus is the three approach. So first, we construct the basic structure. Then this is step one, the five basic workings. Step two, rules for assets and liability consolidation. And then step three, rules for equity and reserves. So consideration of 100% parent subsidiary ownership and less than 100% parent subsidiary ownership. So no serious complications are considered in this session. Complications are examined in the subsequent sessions. So the five basic workings, they start from group structure. So in the question, whenever the question is given, we have to what? Know the group structure, right? We have to know whether the parent is owing more than 50% or less than 50%, and also the actual percentage. So if you look at this question, for example, Grandpa Limited acquired 2 million equity shares in Grandma on 1st January 2020, right? He acquired 2 million equity shares. So now let's look at the total equity of Grandma. So the total equity here, the value is what? 1250, which is, this is in millions. So this will be 1.2 million, right? And then this is the value per share, 50%. So if you want to get the total number of shares, then it is 1, 2, 5, 0 divided by 0.5. Then with this one, we are going to get 2.5 million. So the total shares is for 2.5 million shares. Now, the total being 2.5 million shares, if we want to know the percentage actually the parent is holding, then 2 million over 2.5 times 100. Then we are going to get 80%. Right. So you will be able to define the group structure. Now, if parent is having 80% share, then subsidiary is what? Having what? 20% share. If parent is having 80%, subsidiary is having 20%, right? So let's move on. Now, the rule of the term is that 50% plus defines subsidiary. So if parents have 50% plus, then we have subsidiary. The structure is based on ownership for the purpose of calculating goodwill, group share, and non-controlling interest. It could be based on status to determine whether there is subsidiary, associate, or joint venture. So once you're able to identify your group structure, putting some marks in the exam. So for example, here they are saying A Limited has 80% ordinary shares and whatsoever. So you can see here they've defined this thing for you straight, so you know it's 80% 20. So there is a parent subsidiary relationship, and here too, A Limited holds 40,000 out of the 64,000 ordinary shares that make up the stated capital of B. So if you really want to get your your percentage or your group structure, it's going to be 40 divided by 64 times 100, or 40,000 divided by 64,000 times 100. and you get your A to be holding 62.5%, and the NCI becomes 37.75%. Now, after defining our group structure, the next thing we have to look in for is our net assets of the subsidiary, right? Our net assets of the subsidiary. So we bought a particular company. We want to know the worth of that company as at when we bought the company and as at when we are preparing account. So that's when we create this net asset for the subsidiary. So what will be included in here is the capital or the capital of the subsidiary. That is when we bought the company, the share premium, if there is any, the retained earnings, if there is any, and also any goodwill. That was any goodwill. Any revaluation surplus, it is not in here. So they are all in the reserves. So it will include the share capital, the share premium, the reserves at acquisition. If in case they were planning towards they created some goodwill or they created some kind of trademark when during acquisition, then you have to also include them here, right? And now we have to also examine the these same items at acquisition at the reporting date. So what is going to happen is that we will now bring up the same share capital at reporting date, the premium if in case there's any at reporting date, the reserves in case there's any at the reporting date, right? Then we add them and we add them. Now we find the difference to see whether there's any post-acquisition profit. So post-acquisition profit happens when the figure at the reporting date is higher than the figure at the acquisition date. I repeat again, post-acquisition profit happens when the figure at the reporting date is higher than the figure at the acquisition date. So we find a difference and then we share those profits according to our group structure. So for example, here, if it is 80-20, we share that profit in the rate of 80-20, 80 to the parent and 20 to the subsidiary. Now, we come and then compete for goodwill, right? So goodwill will happen only when the price you pay for is higher than the actual value of the firm. So this is where we are going to use whatever we did in 2 to compute for 3. So it will start with the purchase consideration, right? What we actually paid. And then now we find the value of the NCI, if any. So the value of the NCI might be given in the question, right? In case there's any deferred consideration, like we are going to pay a particular amount later, we have to bring, if let's say 2 years time, then we have to discount it back to the current year and then add it because that's part of our purchase consideration. So after everything, once we know what we are going to pay for the particular business, we come and then subtract our net asset at acquisition from it. Then we get our goodwill if in case there will be any, and if in case there's impairment to the question, to subtract impairment and then get our net goodwill or goodwill that is actually left in the business. We will do calculations very soon so that you get this, right? So that's why it is cost of acquisition plus NCI. Then we less our net subsidiary at acquisition. Whatever we completed up there, we are going to less it from it. Now, this is how we can do. So cost of investment, then group share of net assets, which is the working tool, and also group share of preferred share, if in case there's any, then we will now get our goodwill at acquisition. We less impairment, then we will get goodwill to consolidated statement of financial position. This is when we are using the proportionate of asset method, proportion of asset method. If in case we want to use the full goodwill, right, or the NCI at fair value, then what we are going to do is the cost of investment, then we add our fair value of non-controlling interest at acquisition, we less our net asset at acquisition, then we get what our goodwill, Then we less our impairment, and then we get our goodwill to consolidated financial position. Now, positive goodwill is held as an asset and subjected to periodic impairment assessment. Negative goodwill calls for reassessment of fair value of net assets apart. Any resultant goodwill after the reassessment is recognized in the profit or loss account. So impairment of goodwill recognized as expense in statement of profit or loss. Retain earnings if only consolidated financial position is what? Prepared. We'll look at this very soon. So first, I said we will what? Define the group structure. Secondly, we will do what? We'll find the net asset of the subsidiary. Third, we'll calculate for goodwill or compute for goodwill. Our fourth thing to look out for is to find the value of the non-controlling interest. And this is the most easiest thing you can ever see, right? It's the most easiest thing you can ever see. So now, our non-controlling interest is our NCI or non-controlling interest at fair value, which will be given in the question. Then, if in case there's any NCI share of preference, you add it, right? If in case there's anything like that, you add it. But if not, you don't bring in anything. So what you are going to do is the NCI at fair value, which will be given in the question sometimes, or you are going to value it yourself using here. And which most of our questions that I've seen so far, it is at fair value. So we are going to use that one. And then now, whatever you did here, right? Remember after I said when we got the post-acquisition profits, we share them into two. We share one for the parent and we share one for the subsidiary. So you are going to add what you shared for the subsidiary to the NC share, the NCI listing, then you get your fair value or your value for NCI, right? Then now, after that, you move on to the group retain or group reserve. Mainly, this group reserve is for the parent. So it's about the parent. Keep this, it's about the parent. So now, what you are going to do here is you bringing the parent retained earnings, right, into here. You bring the parent retained earnings. Then the share of post-acquisition profit that was done in workings 2, which was the 80%. So, sorry. So, as I was saying, you are going to bring in your share of post-acquisition profit that is shared for the parent in here. Then, if in case you have any deferred distance that you accounted for, right? You accounted for a deferred payment that you are going to pay in the future, so you brought it back. So now what you are going to do is you are going to find a percentage on that particular amount that you are going to pay, and then subtract it from your retained earnings because you are going to pay that interest later on, right? So we will take a practical example very soon. So here we have the parent company 100%, then the subsidiary group share of post-acquisition profits, then we less goodwill and get the total group profit. This is it for this one. So now after doing everything, we apply the step to the rules for asset and liability consolidation. So we are going to add all intangible assets, both parent and subsidiary. Then we include goodwill, right, in our workings 3. Then we find what our non-controlling, we add our non-current assets, both the parent and subsidiary. If in case there is any kind of debtors or owings between the parent and subsidiary, we eliminate it. We take it out because now they are group. So be and will be aka. So we take that one out. So current assets of parent plus current liability, a current asset of parent plus the subsidiary, credits or debtors in more than 1 year of parent and subsidiary, credits or within 1 year, we add all of them. But if it is between the parent and subsidiary, we take it out. Then the share, so equity and reserve. So equity and reserve, we don't actually add the equity, right? So the share capital and earning at acquisition of subsidiary have already been utilized in ascertaining the net asset for the computation of goodwill. Therefore, only the value in the parent company statement of financial position belong in the consolidated financial statement, a financial position. So first, we can have either cash or share exchange or issue of loan notes or deferred consideration or contingent consideration. All of them, we are going to discount them back to time. So these are some examples here. Right. So I think we've covered what is enough for us to take our first question. All right. So now let's take this question. This is an tutorial set. First question. So Grandpa Limited acquired 2 million equity shares in Grandma on 1st January 2020. On that date, the income surplus of Grandma stood at 300,000. Income surplus is the same as retained earnings. Keep that in mind. So we don't really have to be thinking plenty like that. Same. So the agreed consideration was 1.5 million cash and a further 600,000 on page 1923. Look at it. They bought the company in the year 2020 and they will pay 1.5 million cash instantly, but they are going to pay 600,000 Ghana cedi in what 2023. It's a deferred consideration, right? So what are we going to do? We are when we start to compute, we are going to discount this back. On 1st January 2023, Grandma attained certain profit target. Grandma cost of capital, on 1st January, if Grandma attains certain profit target. So Grandpa cost of capital is 15%, right? The draft statement of financial position of Grandma and Grandpa is as follows. So this is for Grandma, this is for Grandpa, sorry, and this is for Grandma. So the total non-current 4,000, 2,000, the total current 1,050, 1,250, then current liability 4,150,2,900, and the equity 2,250,1,250, revaluation surplus 600, 250, income surplus 1,300, 1,400. So this is an additional information. Grandma has internally developed brand banker, so meaning that it is what it has a brand already, which was valued at 250,000 at the date of acquisition. There have been no changes in the share capital or revaluation surplus of Grandma since Grandpa gained control. There is no impairment of goodwill, and it is the group policy to value non-controlling interest at fair value. At acquisition date, the non-controlling interest was valued at 450,000. So remember I said normally the NCI, the fair value of NCI is given in the question, right? So require show only the 5 basic workings needed to prepare the consolidated financial statement. and then prepare the consolidated financial statements, right? So let's begin with this. All right. So now let's start with the group structure. As I said, the workings. So basic structure. Right. So please, the BAJCR election should be running soon, be coming up very soon. Please, I will need your support for a very cool friend of mine, who is by the name GK Gabriel Oju Osafo. He'll be contesting for the uh, organizing secretary position, and also Custodia, who will be contesting for the general secretary position. Kindly vote for them for me when the date is due. Please, for my sake, kindly vote for them for me. And also Yao Brempong, who will be going for the financial controller. He's also an accounting student like us. If I need your support for them. For presidency, it's tentative. I'll bring it very soon. But I'm going for I'm going to support the bright and otherwise. All right, so now let's start. So let's start with the 5 basic workings. First is group structure, right? So the group structure here is, now let's find the total number of shares for. Total number of shares for subsidiary is going to be the value of the share here divided by the price per share. So the number of shares is going to be 2,500. Right. Mind you that everything is in 3 zeros. So 2,500. Right. And now the parents acquired, so basically it means for 2 million, 2.5 million. Now the parents acquired what? Acquired 2 million. Right. It will be equivalent to 2,000. Right. So how do we do this? What we are going to do, if we want to find the group, the group structure, is going to be The name is grandma, right? So grandma be having grandpa here. Is going to be equal to this divided by this times 100. We are getting 80%. So it is more like this. It's more like something like this. Right, then we get 80%. All right. So now, since we have it, then NCI, non-controlling interest is what? 20%. In total, they are going to get 100%. But in total, we are going to get 100%. So the group structure is what? Grandpa is owning 80% shares and NCI is what? 20%. Now let's try and then bring in our date of acquisition and then reporting date. This all attract marks. So our date of acquisition is 1st January 2020. The reporting date is 31st December 2020. Right. Now this is it for our group structure. And we move on to net assets of subsidiary. So 2, net of subsidiary, which is for which program. So remember I said we'll start with what? The equity. Remember to account for this at the acquisition date and then reporting date. And we've already stated our acquisition and reporting dates here already. So we don't actually need to restate the dates below it like that. If you like, yeah, let's go into that. Get some marks there. All right. So now we start with equity. Equity at the reporting date was after the acquisition date is the same 1257. Right. So here we are reporting the values, not the number of equity, but the values, right? And at the reporting date too, we are still having the same amount. So at both, normally both at the acquisition and reporting date, the shares will be the same amount, or the value of the equity will be the same amount. So 1250. Then we move on to our retained earnings. Right. So we were told that at acquisition, income surplus stood at 300,000, which is the same as. So let's just service. We all have reserves. Right. The retained earning at acquisition was 300,000. Then at reporting dates, let's look at reporting dates, retained earnings is at what? 1,400. Right. So we bring it here. So they are used interchangeably. Income surplus or retained earnings, they are the same. Then they told us that at acquisition, Grandpa has developed an internally brand called Banker, which is for 250,000. So Banker will come. If some questions will not have anything like this, so you wouldn't really bring it, right? For 250 at acquisition, and then it will be the same at the reporting. Then we were told that there is a revaluation surplus, right? Revaluation surplus at acquisition. So you see, they said there have been no changes in the share capital or evaluation surplus of Grandma since Grandpa gained control. That's why we had the same equity to be the same thing. And then now revaluation surplus is the same thing, so we put in the same thing there. Revaluation surplus is 250, 250. So now there's nothing again to worry about here. We are done with everything now. Now let's look for the profit. So sum everything. So our post acquisition profit is going to be the reporting date profit minus the acquisition date profit. So this is our post acquisition profit. So now let's share of post acquisition profit. So now let's start with parents. My parent is 80%, right? So 80% is the same as 0.8. So 0.8, 0.8 times the profit here. I'm getting 880. Then for subsidiary, Subsidiary is 20%, 0.2 times. So this is for the subsidiary and this is for the parent. All right. So now we are done with workings 2, workings 1 and 2. Now let's go to workings 3. That talks about computation for goodwill. And I told you that if the goodwill is as a result of we paying more than the actual value of the firm, right? So now, what are we going to start with? We are going to start with our purchase consideration, right? Purchase consideration. We actually paid 1.5 million for the distance. So paid one, yeah, right? Paid 1.5 million, which is equivalent because I'm putting 3 zeros at the top, right? Then we have a deferred consideration to also pay. Deferred, because the question said that they are going to pay a further 600,000 on 1st January 2023, right? And we bought it at what 1st January 2022. It is what a 3 years something. So let's discount that money back to the currency. So it is going to be 600 times 1.15 raised to the power. Where is the power? Just raised to the power -3. Right? Can do it that way. Or you can do 600 divided by 1.5 raised to the power 3. Still the same. The reason why we are using 1.15 is the cost of capital is 15%. And this is how we normally discount things back in business finance. So this is going to be equal to 600 times 1.15 raised to the power -2. Normally in our exams, we are told to leave our destiny to the nearest target. So when we run it, please how to like. All right. So after doing that, we add our fair value of NCI. So fair value which was given in the question to be 450,000. So 450. Now we sum everything. So after doing this, then we less the actual value of the firm when we bought it. So when we bought it now, what was the actual value of the asset that was in the business? Right. So this is when what we did in workings two will come in here. So at acquisition, this was the net assets. At acquisition, this was the net asset. Right. This was the net asset. Then hence we are lessing it. So this is going to be a goodwill. In this question, there wasn't anything. They said there is no impairment. If there were to be impairment, you are going to subtract it from the goodwill. Right. So this will be the goodwill. Right. So we are done with workings 3. And I told that workings 4 is the easiest workings you can ever see. Value of NCI is the easiest workings you can ever see. So value of NCI is basically the NCI at its fair value. This was NCI at fair value, right? Just bring it here again. All right. So now NCI at fair value, then we do what? We bring in our share of post acquisition profit, share of PAP. Share of PAP, right? It is going to be equal to, so this was in workings 2. This was in workings 2. Or we did in workings 2. Yeah, so the subsidiary. That's what we are having here. This sure. Oh, sorry. This should be this one. Sorry. Corrected. So this will be the share of profits. So I mistakenly chose this one. All right. So this is it here. Then we add them and get our fair value. So this is the fair value of NCI, or value of NCI. Then we move on to the group retained earnings. Now, group retained earnings, what we are going to do is to bring the parents retained earnings. Remember, I told you group retained earnings is basically for the parents. That's what I've learned so far. If in case I see anything, I'll bring it here. So parents retained earnings. Right. So what are the parents retained earnings? So 1,300. That's it here in terms of your 1,300. Then share of PAP, share of post-acquisition profits, right? It should be in working is 2. Equal to this, right? Then because we have a deferred payment paid and we've discounted it, but you have to be putting money down for it most month. So let's unwind discount, which will be 0.15, the 15% times the 395 that we calculated for. So we calculated for when we were bringing it back, it was 395. I mean that each and every year we are going to pay 15% on it because we brought all the 15%, we've taken it, we've taken all of them out. So we are going to pay it bit by bit. That's why for the first year, this particular year, we are going to pay only 15% of it. It's going to be equal to 0.15 times 395, which is 59, right? And remember, we are going to less that one. So it's so summation of them. So this is the summation. Right. So you see, this looks simple. We are done with the working. So this working even carry more than the actual consolidated financial state position that we are going to do. You see. So now we are done with it. So we come to grandpa group. We are now coming to create the statement statement of financial position. So then we're now going to create the statement of financial position. Right. So we will start with non-current assets. Let me just bring we are dealing with whatever in Ghana cities. I've not brought the currency sign. Pardon me. Try your best with the currency sign when you are doing it. So now non-current assets, right? We start with our PPE. So what we are just going to do now is we are going to add the parent and the subsidiary, right? So PPE is 25 Remember. So now we just consolidate them, we just add them. So now we have we have 2500 plus 2000. Right? This will be for our PPE. And then we have the generated a brand, which is an intangible asset, right? We have banker. We'll bring our banker here. Where's the banker? Banker was 250. Then we have goodwill. That's with it. There. There's our total non-current assets. We move on to our current assets. Our current assets, what do we have? We have inventory. We added two inventories, right? So 150 plus 400. Then we have receivables. There's the receivables. Then we have cash and cash equivalent, which was 100. So now we add all these. And then the total asset is 100. Right. This becomes our total assets. Right. So now we move on to our equity and liability side. Start with equity. Then equity, as you are seeing here, is only the parent stated capital. For equity, I said that you are not going to add anything. Equity will be the parent. Parent stated capital will be this one, the 2250. Then I move on to the group retaining, the one that we did working 5. It was equal to now we add our evaluation. The sample. Then our value of NCI, which was done in workings 4. It was done in workings 4. So this is what will be needed here. Then let's sum them. All right, so this is what we get for the equity. Now let's get to the liabilities. For our non-current liability, NCL, let's we don't have any non-current liabilities here. We don't have any long-term liability. So we have uh, current liability. So let me just use the liability. So we have, let's bring it on deferred consideration. We have NCO. NCO will be the deferred one. Deferred consideration. Right, the deferred consideration, we will have to we'll have one that we are supposed to just pay uh, next year, and then one that we are supposed to pay in the next 2 years. So the next 2 years one, which is because it is more than 1 year, right? It becomes non-current assets. So we are just going, it is going to be uh 395. 395 is going to be current assets. Okay, let's split it this way. Third consideration plus 0.5 times now it's going to be like this. 395 So it's going to be the 395 that we are going to pay plus its interest, right? So this is what we are going to get. And then now we have payables. Payables, we have trade payables here where we have 900 plus 350. There's it. Then balance. Topic na de corner balance. People in the corner balance it. That's right. So now you see we have our equity and liability to be equal to accounting there. Once you are wrong, you know you are wrong. Sometimes you wouldn't know where you go wrong. So this is the first session of this. I'll try my possible best and then solve some extra questions, and then we move on to the joint associate, and we do financial ratio and analysis, then we do reconstruction again. So thanks for your time, and then kindly like this video if you have not liked it, and also subscribe to the channel. See you some other time. Bye.